All right. What's going on, everyone? This is Jake here from WeTradeHQ. I hope you're having a fantastic day. We got a really awesome video for you guys today. So I'm joined with Imran Dean, who is an investment professional. He focuses on venture capital, private equity, equities in general, and just has, in general, lots of experience when it comes to that. He also manages Investor Hub on Instagram, so be sure to check him out. And today we're going to be talking about private equity and what it's all about. Our channel mostly focuses on trading stocks, trading public equities, and it's going to be great to get some knowledge on how the private industry works with private equities, because I feel like a lot of people don't know how it works on the back end. All right, so first question, like, from basically what is private equity, and from what I know, it's basically when you invest in a company that's not on a public market. But I'm sure you could explain it better, Imran.
Yeah, so in essence, it's companies which aren't traded on a listed market, hence the term private. But the way in which you can acquire, or individuals can invest in private equity, some you can actually invest in private equity through a listed vehicle like ETFs or in funds. But in essence, private equity is investing in businesses which aren't listed on the stock exchange. And then what you have is you have private equity, and then you have, I guess, the more sexier thing that people talk about now, which is venture capital. And venture capital, again, is buying equities in businesses which are unlisted or unquoted. And I guess the notion is, and how it started was, the big thing about private equity came out in the 80s in the US, out of some of the famous guys like Henry Kravis and some of the big private equity guys in the US. And what they were doing was what they call leverage buyout. And what they used to do was they would take companies that were public and buy them out, but they themselves wouldn't have all the funds necessary. They would borrow money and debt, and they put that debt on the balance sheet of the company they're acquiring. So that company would then service the debt. So that's how an LBO works. It's the structure of where you put the debt into the company that you're buying, that pays off the debt, you own the equities, and then when you sell it, you get the debt. The debt is hopefully paid off, but you get whatever your equity is. So you put in only a small amount, but the value that you got out is huge. And if you look at history, like if you look at the last, I think, 30, 40 years, private equity after fees actually gives you a better return than public markets. So I think so. Like for pension funds and these institutions, kind of for my world, obviously WeTradeHQ is like for the retailer, but I'm sure a lot of your retail clients, your retail kind of followers know, and I guess individuals know, that when you look at funds or investment funds, you have to think about the fees that you have to pay to a fund manager, right? So hence why people want to invest for themselves, and kind of what I try to do at InvestHub as well is kind of say, well, you can outperform to an extent. But back to the point, 8.1%, I think, over the last 10, 15 years compounded, versus I think public markets was saying 6.1%. And I guess the reason for that is, the reason why private equity has those great benefits is you actually, when you're involved in a private company, you have direct say in where the company is going. So it's a bit like, you're not buying just small amounts of shares, which maybe are less than 1% in aggregate of a company. You're buying, at least 5% minimum, but we're talking maybe 10, 15% equity stakes in companies. So you have a voice in what happens. You can make, it depends a lot. So the way it works is the difference between buying a stock in the public markets and private equity is a bit more complicated. So private equity, as an institution or as a group of people, it's a lot more legal work, right? You don't go to a broker. You don't go to your broker and say, I want to buy Amazon today, or I want to sell Amazon today. It's a longer process, because you have to personally negotiate price. So the price discovery is where I think a lot of the interesting stuff happens in private equity, because you can get real bargains, right? And I think that's where it's really, really interesting, is where, how do we value a stock? And it's very much an art in the private game, because it's what someone's willing to pay for it, or what someone's willing to sell for. And that's where really interesting opportunities happen, because let's say there's a disgruntled shareholder who wants to get out, because one of the issues with private equity and the cons is it's illiquid. So like on the public side, you can buy and sell today and tomorrow.
That segues perfectly into my second question. Um, you know, essentially, like to explain it, I guess as simple as possible is before Microsoft or Apple went public, if you were invested in the company prior it went on the Nasdaq, you would be essentially owning private equity. And so it's a perfect segue to my second question, which is, what are the pros? If you could list me 2 to 3 main pros of private equity over public markets, over trading on the Nasdaq in New York.
So I think you have more say and ownership of the company. So you have a bit more control of the outcome, which actually, if you're a person who understands the underlying business, and I think that's where the key is. If you have an understanding of what the underlying business does, then having a private equity investing can be better for you, or beneficial. I guess secondly is going back to the point that it's possible to, it's kind of diversification as well. Like if you don't want to have the market exposure and you don't want to have, like if the stock market goes down 20% and there's a recession, your stock's not going to get hit, right? Because it's a private investment. It's not mark to market. It's it's a longer term play. Obviously, the company might be hit, but again, you have clear sight of what's happening, right, on a monthly basis. So that's you can have those diversification benefits as well. And then I think I guess the third one is just the sheer returns. Like if you look at it today in the world, like how many companies are not doing IPOs? I mean, WeWork is going to do an IPO later on this year. I mean, we know like this year already. And look what happens when they do the IPO. They all just kind of flop. Like
I know, because all the investors just sell off their shares, and cash out, right?
Exactly, but that's where you can make massive amounts of wealth, and that's where the venture capital game gets really interesting. Because if you invest really early, again, there's not really private capital because it's venture. The reason it's venture capital is because that capital is kind of going for growth, right? You're not necessarily buying another shareholder out. You're kind of giving the founders money, so the founders are getting diluted, meaning the founders may be like, let's say me and you started a company today, and tomorrow we wanted to raise money. We would have combined, we would have 100%, but after we had investors, we might go down to 80%. And that's the idea: is they lose ownership over time, and they're giving away equity in exchange for cash to grow the business. And that's where this huge returns, right? 100 times, and that's where people build massive amounts of wealth. Just being buying, having stakes in these private companies. Whereas I think when things go public or in the public markets, there's a lot more price discovery, and I think that's why private equity is more interesting. It goes back to that. The reason why you get greater returns and the potential is because of that price discovery. You can say it's similar to like penny stocks or small cap stocks, which are less covered. When there's less coverage, the markets are more inefficient. There's less price. Real price, or what is the value of this business, it is less clear, and that's where the greatest opportunities are, right, when it comes to investing generally. It's the same case with, and I think that's why sometimes illiquidity, there's the illiquidity has disadvantages and advantages. I guess we can talk about the disadvantages as well of private equity if you want as well.
That's my next question, so go ahead.
Okay,
but just summarize that before we move forward.
So I guess it's so number one, it's you get greater control over your investment. You can have more say. Number two is that diversification benefit, and number three is the potential for real astronomical returns
instead of just 10%. So perfect. So that's great. That's kind of the pros of private equity. Let's now move on to the cons, because I know there is some. If I were to think off the top of my head, it's a bit more riskier for sure if you're getting into something early.
I think it's risky. So it's risky because of the illiquidity, right? Because once you, like, let's say me and you went and bought 15% of Theranos. You remember that healthcare? The scandal, right? And then what are you going to do? Because I think that's a really good example to start with, because you have really bad corporate governance. You had, essentially fraudulent. I think there were fraudulent actual account numbers in terms of invoices, which weren't true. So you have management, which you have to get rid of. You have a company which actually isn't making the money it is. So straight away, you've got huge problems. And if you don't come from an operational background, or you can't add value, then you're kind of stuffed, right? Because you rely heavily on management. And that's kind of, people don't talk about it. And although you have investor protections in private equity, at the end of the day, you are somewhat reliable on management, right? But
Yeah,
if you have a Fortune 500 company, if the CEO goes tomorrow, there's business continuity plans. It's a big company, huge company. Structures are such that somebody else can take over. There's less key man risk. Whereas in private equity, you do have that key man risk. And even as an investor, then that causes the illiquidity. You can't get out. And again, it's price. So one of the things people don't know is a lot in private equity is the vintage year. So like today, in today's market, we're in a very high kind of valuations, right? Where public equities are, kind of all-time highs, and where the markets are is fairly rich relative to its history. So if you went and invested in private equity today, you're investing at the height of the market. So let's say if you wanted
true. That's not true.
So and the reason I'm saying that's really important is because for retail clients, meaning individuals like me and you, we don't have massive amounts of wealth. The only way we can get into private equity is going to be through funds or through ETFs. And you just got to know that you're investing at that vintage where if the fund is launching today, it's buying expensive assets, right? It is buying at a peak, right? Where valuations are very high. And I guess the thing with the valuations, which is different to kind of public markets, is it's more multiples. So the way the private equity guys kind of analyze companies is to say, okay, it's EV over EBITDA, which is basically EV is enterprise value. Enterprise value is the sum of what you would regard as market cap in public equities plus debt, less cash. So if you were to buy that company today, you'd get the cash already, so you can subtract that out of the value, and then you divide that by EBITDA, which is earnings before interest, tax, which is essentially a proxy for what you would say is free cash flow. And it's those multiples, and people pay maybe like 9 to 12 times, right? So
So
you pay 9 to 12 times that EBITDA multiple.
It's
and then when you buy that,
right? That's
so I guess in overall,
So all the VCs care about the potential, like how much could it be worth 5 years down the road, 10 years down the road? Yeah,
exactly,
go ahead. Sum up the cons.
Yeah, so essentially the cons are it's illiquid, and that illiquidity means that it's far more riskier to invest, right? Because you have to be able to say, I'm not going to see that capital for a while. You're relying heavily on management, so you've got to have good due diligence. So if your due diligence on management on the company is poor, then it's difficult to then do well from that. So again, this kind of space tends to be left to the professionals because it's very difficult for people to take huge sums of their salaries and invest in private businesses. But again, if you have good interest, good insight into businesses, then it can be quite lucrative.
All right, right on. So yeah, it sounds like, it's good to hear both sides. Awesome. That's my third question. Fourth question, say you're looking to invest in a company and they are private, they're not publicly traded, when should you as an investor, or if you work for a firm, what kind of key points should you be looking at a company? Should you be looking at obviously their profit? I don't know how many employees they have. What are some key factors you want to look at?
So when you're looking at, there's two different worlds, right? You have the venture capital world and the private equity world. I think let's talk more about kind of venture capital, because I think that's what people get excited about, and I think that's what retailers through. I know that in the UK we have things like Seeders and we have these crowd-funded platforms, and I think you have that in the US as well, the equivalents, right? So you can invest in them, and what you're looking for is when it comes to venture or VC, is how big the market opportunity is. Then you're looking at, I guess, founder problem fit. So how close the founder is to the problem he's solving. And then you're looking at the competition and where the barriers to entry are, right? Like you say, it's very similar to the Porter's 5 forces, which is, like the competition, barriers to entry, threats, opportunities. So it's very much doing that business analysis. And then for the private equity side, it's more, they're looking at very stable and steady cash flows, and it's like, can we squeeze the costs? Is this a business which fundamentally has a moat, meaning how Warren Buffett says around it, and you're just trying to squeeze the profit out of it. And
now let me ask you this: do you see from your own experience, do you see these private equity, you see a great company, they have a great product, but then when a private equity firm comes in, do you feel like it could potentially ruin their product or their business for the customers because they're solely focused on the profit?
So I think your question was, do you see a good opportunity when a private equity company buys a company? Do they end up doing well or not? Is that what your question was? Or
yeah, so like I feel like some private equity firms might come in and ruin the product, ruin the company because they're focused on squeezing that profit and the customers or value.
That's quite funny because you say that, and I actually exactly, and I've been speaking to a colleague of mine about that, and I said that's kind of why I think private equity struggled, and it is struggling now, and the future of it's changing, and it's moved away from buying a lot of companies to they'll buy a company and they'll do a lot of acquisitions to bolt onto it, meaning to grow it.
Okay.
Because the issue they're having now is in a company, like everything is being disrupted in any industry. Disruption is there, and if you are just focusing solely on cutting costs and squeezing margins, squeezing costs to improve margins, then you're not looking at the disruption or the innovation side, right? And that's what kind of private equity guys are doing, and they're ruining the products and ruining it. And I think a perfect example in the UK is like there was this Addison Lee, which is like a cab company, and it was the equivalent of it was a pure cab company, all offline for a long time. Then they did an app after Uber came about, but a private equity company bought it, and they couldn't do anything with it because you can't. It's not about cutting costs; it's innovating, and the fact that everyone's using an app now. And I think when they created an app, but it still was nowhere near what they could have done. But going back to the way they structured it about the debt and the equity we talked about earlier, I think they still did relatively well. But
that's good.
But the problem is it's not a long. They're struggling, especially in retail. Like all retail private equity firms have done really badly. Like all private equity firms that have invested in retail have done badly generally, except for I think there have been cases where they've invested in like pets. So pet retail stores have done really well because there's a strong niche and it's difficult to break that. So the barriers to entry are harder. But I think where there's going to be massive disruption in industries, that strategy won't work. I think the strategy which will work is putting money to use, but also having a return on investment. And I think even the VC world, I was watching an interview the other day, and even they were saying the amount of capital that's going in without thinking about profitability is a bit scary. So people are just piling in billions of pounds into these big companies to try and solve problems, but you may never see that result on the bottom line. So there's a lot of that going on. There's a lot of money chasing fewer ideas. So it is it's a bit of there's a lot of capital out there, but maybe not people aren't making many smart decisions. So I think private equity will change, and it will be a bit more about kind of build and buy and build. And I think this LBO model, essentially, which we were talking about earlier, is kind of dying, because if you cannot squeeze or get that much profitability, there's not going to be that many businesses I think out there which aren't going to be disrupted. Not businesses. There's not going to be that many industries which aren't going to be disrupted. I mean, even when we look at what you guys are doing with WeTradeHQ, right? Yeah. And it's kind of the mix between education / financial education / even offering even being a platform where people can analyze stocks, right?
Social network,
has changed as well, that world, right, where it was made, and like Bloomberg.com is no longer necessarily the place that everyone goes to. It's too financial. Even Yahoo Finance is okay, but they haven't innovated for a long time, right? And you have the likes of Robinhood and Webull and all these guys coming out with better platforms for people and mobile first and zero commission, and people are going to struggle, I think, and if they don't keep up with that. So buying these kind of businesses, these broker businesses like institutional investor and the older ones, where it depends on what these private equity guys' strategies are, but it's got to be very much okay. We'll buy one and we'll buy another one maybe, and we'll kind of grow it and see what we can do and innovate from that way. But I think it's going to have to be a lot more putting money in and investing a lot more versus buying and squeezing and cutting costs.
Yeah, actually investing in the product that they're working on.
Yeah.
Awesome. Before we wrap it up, what are some maybe top companies that people might know around the world that are actually majorly owned by private equity firms? I know, I think Jaguar and Land Rover are owned by Tata Motors. I don't know if they're a private equity firm, but what are some really big companies that people might not think are actually owned by a private equity firm that you know?
I think Burger King is pretty.
Okay. Yep.
Pretty sure Burger King is. I'll double check that actually. Then you have, I think it's Coke Industries in the US. Is one.
Okay.
What else is there? Like a big private equity company. I'm just trying to think at the top of my head.
I think Geico, the insurance company, is owned by Warren Buffett's Berkshire Hathaway.
Yeah, exactly. I'm trying to think of a kind of US kind of focused ones as well. I mean, I guess.
Burger King, you are right. I just checked. You are right. There's no.
Burger King, and I think there's. I mean, on top of my head, I'm trying to think of a few others that have gone private as well. I think the issue is it's just keeping on track, right? Because a lot of them are doing, some of them do IPOs and go back as well.
Yeah.
I think there's.
That's all right. I just thought it'd be cool.
There's Westfield as well. I guess the shopping mall.
Okay. Yeah.
That was sold to a group, and then I think the other one is, but it's not. It's Time. Time magazine was bought by an individual. So Time magazine was owned by. I think it was the guy who started, what's it called? I think he started one of the big. I think it was Salesforce, but I can't remember now. I think he started Salesforce, or one of the big kind of IT in the US. He personally bought Time Inc. And then you've got and of course Washington Post is owned by Bezos himself.
Bezos, yep.
Not Amazon doesn't own it. He owns it, I think, through his own.
And that's
fortune. I don't think, as far as I understand.
That's technically private. Yeah. Bezos had enough cash to just buy it out.
Exactly. Then you have Hamleys, which is like the retail group in the UK, which is also private. I mean, Harrods is private. So Harrods in the UK. It's a big kind of shopping mall that's private. Mm-hmm. So there's a lot. I think a lot of the food kind of companies, like a lot of the food companies that you see probably in the US as well, which aren't to a certain size. Some of them are most of them, they could be private as well. I mean, I'm not that aware of US focus, but I can tell you more on the European side and the UK side.
Oh, that was great. Honestly, Burger King hit the spot. So as long as I felt like a lot of people didn't realize that, and they all think, they own stock. I mean, the Mars candies, they make M&Ms and Mars bars. They're privately owned. They're family owned forever. So
I mean, a lot of it's. I guess the perfect example is Donald Trump.
Yeah.
So it's a private business, right? You can't own his company. It's family owned, right? And it's all entirely private.
Yeah.
But yeah, it's like, I think the thing is, all the bigger companies that we hear of now, they're not. I mean, WeWork, still private.
Airbnb is still private, but I think they're IPOing soon.
Exactly. So yeah, there are these IPOs that are coming out, right? So it's a bit, do you want to? You can't necessarily say they're all But there are some interesting opportunities. Like me and you can't invest in, let's say, a WeWork now necessarily. It'll be hard because you can get maybe a pre-IPO, and that's an interesting space to be in as well. Just in an IPO, after the IPO, buying stock and seeing. Most of the time,
we'll save that for another episode. We can talk about.
And I guess most of the time they flop as well, don't they? So you got to be a bit careful.
Yeah, exactly. Anyways, Imran, thank you so much for the talk. I hope you guys find a lot of value in this. Before we ended, I wanted to talk about you're starting a mentorship on WeTradeHQ. So let's kind of talk about it. You're very experienced in the private equity markets and long-term investing. What can people kind of expect from your mentorship and learn?
So I think the key is I want to focus a bit on, I guess we'll start with education and understanding like portfolio construction, asset allocation, doing like degrees in finance, and I guess hopefully, just done the final level of the CFA, which is the Chartered Financial Analyst program, which is essentially being a portfolio manager. So from that, it's a lot about how do you manage your wealth and portfolio construction from that perspective, and where you might not want to be fully in equities. Do you want to be in what other asset classes can you invest in? I get a lot of questions about REITs and real estate on Investor Hub, and you don't have to necessarily buy an apartment or a condo, right, to actually have real estate exposure, right? You can do it in many different ways. So it's how can you best get diversification in your portfolio and your wealth, right? Because even with you guys and what you guys talk about, and I know is not everybody is fully invested in 100% of your capital is not going to be invested in equities or is going to be invested in fixed income, right? You're going to have a diversified portfolio. So it'll be education on that. And really, I want it to be Q&As. Like, what questions do you have? Because I'm not here to tell you, go and invest and buy these stocks and that, because at the end of the day, each individual has their own circumstances, right? I'm there to teach you what makes sense from your long-term capital wealth preservation.
I love it. Awesome. Yeah, I think a lot of the WeTradeHQ members will see value in that. And not everyone wants to day trade. You know, some people might just want to, you know, set up a portfolio and kind of let it run and watch it grow instead of looking at, you know, red and green candlesticks all day. Not everyone has time for that. Some people have a job, maybe they have.
But I mean, also the guys who do that have built tremendous. I mean, some of those guys have built tremendous amounts of wealth, and then if you made $30,000-$40,000 doing that, then you're like, actually, I only want to trade with 10,000 now, and I just want to have that as my monthly expense, you know, my monthly paying my expenses, but the rest I want to just kind of grow it through longer term investing, right? I don't want to risk all my capital.
I love it. I mean, and that's something I personally want to get into is that, because I am making obviously money day trading, but it would be nice to get some dividend paying stocks, get some more, you know, make my money work for me per se. And I think, you know, that's something you could help with. Exactly.
No, definitely. And I'm really looking forward to it. And it's going to be exciting. I think we're going to, hopefully in the next couple of days, we'll be up and running. So, you know, starting to kind of hear what you guys want as well. It's definitely a two-way thing, right? I don't want it to be me telling you what to do. I'm going to learn from what you guys want as well, and we'll improve as we go along.
Totally. Awesome. Well, I'm really excited, Imran. I'm very excited for it. So yeah, anyways, that's it, guys. Thank you so much for watching. Be sure to follow Imran on Instagram, investor.hub, hub is his Instagram page. And yeah, you'll be able to see his mentorship on our website as well. Imran, thank you so much. Do you have any final words you want to say, or?
No, I mean, I think the key is constantly read and learn. There are huge amounts of wealth just learning and reading and then taking action as well. And what you guys are producing, and you're seeing people live actually do that, that's the best way to learn, right? Seeing people who are showing you what they're doing on a day-to-day basis is the best way to learn. But never stop learning. I think investing is a long-term game. I mean, look at Warren Buffett, 500 pages a day. You know, you can never stop learning. And investing is like a puzzle of the world, right? You're trying to figure things out. It's never that easy. You know, it's like a jungle.
Totally. All right. Thank you so much, Imran. And yeah, have a good one, guys.